Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, February 17th, 2020. I'll keep it limited to a couple things here, just the broad market and crude oil and energy stocks. So they're all interrelated. They tend to move together. So let me just dive into the charts, tell you what I see. I already posted a couple things this morning. The two big market leading, what I call now FANGI plus T. Tesla's up there in market cap so big now that it has, like Apple, not just a heavy weighting on the S&P 500 and the Nasdaq 100, but also a psychological importance in the market. When those market leaders break down, if these breakdowns hold, then it's likely to spill over to some of the other big names there. All right, so start out here. The S&P 500, nothing really new on the S&P 500. We had that breakdown there, sell signal a few weeks back, back testing the trend line. So that kept the sell signal. When I say intact, remember the sell signal was negated at the time when QQQ snapped back above the trend line. So, but from a technical perspective, the breakdown, let's say, is still intact because we're back testing, and we're starting to roll over somewhat impulsively. Really nothing big so far, about 0.6% in SPY, but we are moving off the trend line. That's what you want to look for after you've been back testing. And would certainly help, as I like to say, the redder the better. So if by the end of the day we have a big red candle, an impulsive rejection off the trend line, that will help to support the case, to add to some short positions or take short positions or exit your longs, however you see the charts. All right, on QQQ, we're still above the primary trend line. That's the primary trend line off the March lows. As mentioned, we had this whipsaw signal. It came just before, what's it, Alphabet and maybe it was Amazon and Alphabet. A couple of them reported earnings, anyways, and that they rallied after that part. Excuse me, after that point. So that's it. We still have a valid trend line. Let me move this. Some reason this trend line will drift from time to time. I'm trying to get it closer to these the previous candles. There we go, something like that. So we're right on trend. I think it goes because we have what I've been waiting for, the sell signals on Apple and Tesla. And as I said this morning, I think those two, they look legit now, and I think they'll stick. Yes, we've had whipsaws. Yes, the bull trend has been resilient. But the day I stopped doing what I've done for many, many years, and that's being almost mechanical about taking these buy and sell signals, I would rather have another whipsaw, get stopped out, and than to pass on what looks like bona fide sell signal. So that's it. Now let's dive into the futures. That gives us a little more visibility or clarity on the very near term. So what I want to do is jump down to the NQ 60-minute chart. Okay, just most recently, I've been pointing out these divergent highs, divergent lows to come. You want to look to position for a rally or cover shorts, especially if sell signals come or you have any different forms there. And then the divergent highs, you get the divergent highs, you look for a sell signal such as a trend line break, and there's your correction. So that's simple stuff. I've covered it many, many times in the past. Last divergent high was right here. I don't know where my letters went. That was a divergent high, small little wedge, and this is what happened. And I think this will happen again. So far, we're seeing an impulsive move down. We did break since the last update, yesterday's video. We broke down, and then we also, as you can see here, I mentioned that 13,756 was support, little minor price support, and I'll zoom in. I know it's hard to see these charts on the video. And that's what happened. We broke down. We danced on that support for a while, a little bit, brief overshoots, but pretty much we traded right on there, and then boom, once it went, we went down to the next target. That's how it works. So 1350 has been hit. That's the first target. That was just minor support. I don't call that the first target because it was so close. It was my benefit of the doubt line. Needed that, see that 13,756 to go, and it went, and there it is. Now, as I mentioned this morning, you always have the odds. I list multiple targets because those are support levels where a reaction's likely. But with everything going on right now, as I said this morning, I suspect any reaction here will be fleeting, meaning just very minor in time and or price. unless Apple and Tesla can snap back. But I think what'll happen is they'll spill over to the other ones, and I would rather ride out a little counter trend bounce with the shorts I have. As far as stops go, you can keep it now pretty tight above that 13,780. I'd say about 1390, 13,790. There it is, somewhere above these recent consolidations around that first support level. And again, I think now is a good time. If you want to be aggressively short, you want to wait to see that trend line on QQQ go on a solid daily basis. You can do that. That's nothing wrong with that. But I do expect the selling to accelerate if and when we see some of those other market leaders roll over. I'm talking about Amazon, Microsoft, Alphabet, Facebook. If we see the breakdowns again, and Apple and Tesla stick. And so therefore, we're looking at, I think, again, a pretty decent drop. And we'll play this one by ear. It's so early right now. We don't even have the sell signals on the QQQ daily yet. All we have are two of many stocks breaking down, and maybe I'm putting too much of an emphasis on those. So it's something, it's a fluid situation. I'll continue to monitor it, see how those guys act. Maybe the buyers step in, maybe not. But let me jump into the other trade ideas for you and the other charts. So again, technically speaking, this is just a nice setup. We have again the first divergent high since back here, and that one led to a nice tradable correction. And I think this one, because it is a much larger, by the way, this divergence right here started at the same time this divergence did. So that was a small divergent high from the same point that we started diverging right here. And this is much larger. So what does that mean? It doesn't guarantee anything, but typically the larger the divergence, the larger the drop. So therefore, even if we drop just to that level that we did before, it's going to be a larger drop because we're still coming from higher levels. Here, let me measure it out. That would be a drop from the highs of about 9% right there, 8 to 9%. I'm trying to get the closer to 9%, and certainly the potential for more if the rest of the market leaders break down. Alrighty, let's move on, and then I'll get to the energy stocks. The S&P 500 futures. This is also a 60-minute chart. There's our uptrend line. This was our primary uptrend line, and I'm just extending it here. This was that sell signal I pointed on SPY, and the same thing on the SPY daily. And like I said, we've been back testing, and now we're rolling over. It's a little more impulsive than the last time we rolled over, but once we clear out these recent lows right here, and that would be around, give or take, about 38. You want to play it safe. There's nothing wrong with playing it safe now. We'll call it about 38.75 or so. Once that level goes, that should be a clear rejection off the trend line. Remember, basically all we did is we broke down, back tested, and we're back testing, and we're failing right at the apex. If I take the trend lines, actually that one's weak. That one should be down a little lower, that divergence line, but right there, roughly the apex of the triangle, or the wedge, I should say, and divergence as well. And the small caps, a lot of meat on the bone for the small caps once that trade gets reversed. In other words, once the tide changes. It's been a rising tide for a while, but we've had corrections along the way. Small caps tend to be a little more volatile. Last time we had a divergent high was back here, and from that divergent high, it was good for a drop of about 7, almost 8%, 7, 8. And this is the next divergent high that we have. That one ended again with a divergent low right there, and that was a catalyst for this move up. Nice clean up trend line. It broke down. We didn't sell off right away. We moved sideways for a while, but I believe in yesterday's update I said we need to clear out these recent lows, and that's been taken out. So that gives us the next sell signal. This was a sell signal, and that's just a little consolidation, and then boom, there was your next sell signal today. And provide an objective short entry. You want to keep stops tight, just keep them above. There's a recent cluster of candles right here. You can keep it above there. And if you're swinging for more than just a single or a double, you want to hit a triple or a home run, set your stops above the recent highs and hold out for this or potentially more. Again, a little more work to be done. I'll do an update certainly by the end of the day. To just see, I'm just very curious to see how Tesla and Apple follow through today, and some of the other market leaders if they start to show signs of cracking, which they haven't yet. Okay, and we'll roll into energy, which also, goes hand in hand often with what the dollar's doing and the euro. I like to use the euro as a proxy because it moves inversely to the dollar index. Is the largest component by far, so it's almost an inverse mirror to the dollar. So this is there's that high in the euro right there. Correction, my third target zone hit. Put in divergent low, had a typical reaction off the first hit of the target support, and the divergence played out for a rally, and now we put in a divergent high recently, and we've been moving sharply lower. And as I said yesterday, we need to take out that low, and that would open the door for a much deeper correction and tell us this was just a counter trend rally in a larger correction in the euro, which would also be a rally in the dollar. Which is this? This is DX 60-minute chart of dollar futures. There's your positive divergence. And crude oil tends to move inversely to the dollar. Dollar goes up, crude tends to go down. Saudis just announced they're going to start ramping up production due to the rise in oil prices. That certainly can't help crude oil. But let's look at the chart because I think there's a trade. In fact, this is one of my top picks right now for a short is crude oil and the energy sector. I already gave you my take on the markets. A little more work to be done there, but crude oil, as well as the energy stocks, tend to move with the economy because if there's positive economic growth or expectations, doesn't matter whether there's growth. It's just what people think is going to happen, and that goes hand in hand. If the economy starts, really coming back 110% online, airlines are full. Trucks are on the road, capacity, and et cetera, they're going to be using a lot of fuel, and so otherwise this goes down. But that's a fundamental thing. Let's just keep it very simple. Sometimes the fundamentals just don't make sense, or it takes a long time for them to be priced into a stock. Technicals are what I go by. This is a beautiful bearish rising wedge with some steep negative, very steep divergence. Look at that. Look at that slope. Look how low the PPO is. This lower peak right here. Versus that higher high in prices. That's negative divergence. So there's crude oil with a sell signal to come on a break below this wedge. I personally, I've gotten in front of this when I shorted it today, and I will certainly add to it if and when it starts to pan out, and look for these previous reaction lows to get taken out. Where do I think it's going? Make it quick. At least back here to 53.89, 53.90 we'll call that. That's the top of this. You can see this consolidation range right here, and quite possibly the bottom of that range. What would that be from where we're at right now? We're at 60.27 in CL. These are crude futures. Drop down there is about 10.5% to the top of that trading range. And if it gets to the bottom, that would be almost 14%. So one of my top picks right now. Again, if you short it here, it's aggressive because you're shorting above trend. So I like to layer into things, and if you don't like the big contract to CL, you can take the smaller contract, which is a QM. QM is the mini contract. Trades off these same levels, it just has a smaller leverage factor. So and if you don't trade futures, USO, and there's also some inverse ETFs or ETNs you can buy to trade crude. And another way to trade crude is that's a direct proxy, tracking crude prices using futures, or the ETNs that trade the futures. And then let's talk about the energy stocks, and we'll wrap this video up. Okay, about a month or so back, I started outlining a short trade, an aggressive short trade entry on the energy stocks, and give you targets and levels to watch. And my preferred proxy at that one for the energy stocks was XOP, although I mentioned XES. You also get a lot of bang for your buck. XLE tends to not go up and down as much because this is big oil XLE, and either way, here's what happened. At the time, we had, let me loop back. Let me just start with the smaller ones because that's the one I focus on. XOP was at a pretty good resistance level right here. And so that was the case for short. And that was a good drop. It was, we hit it. Targets were based on the 60-minute chart. It was right here. 63.71 was my first target. 57.17 a second target. And we hit that first target, and the drop was about 13%. So twice that if you bought drip when we were at resistance. But what happened is we hit that first support level, forced target. We had a reaction as expected, but it was a pretty strong reaction. Bounce more. I figured we might get a bounce up and get one more leg down. However, if you go back to that video, and I'll try to, if I, I'll try to dig it up and post it below this one. I said at the time that XOP, while at resistance, there was a gap right here and a reaction high there, and that. I said, while at resistance, this is an even better resistance level. So where I'm going with this, and I'm going to be very clear, I like it even better now because this is the big resistance level, 80.35. Those are key reactions right here. That when that level broke, we went back tested it from below. Once it was clear that the XOP could not regain these major reaction lows, that was big support, the bottom fell out. Was it related to COVID? Yes, but the charts and fundamentals go hand in hand. I will go to my grave, maintaining that. I've done this long enough to see that it's not just mere coincidence that bullish chart patterns break out, and then the news, if there isn't a fundamental or news catalyst at the time, there will be one that follows. Same thing here with that COVID drop. There was a lot of evidence to short the market, short energy stocks and everything else back then. And COVID certainly just made that correction happen quickly and to an extreme level. But either way, technicals are technicals. Make no mistake about it. So this is what I was saying. Big level, 80.35. And we, came close enough so far on XOP. That high was, 79.59 today and yesterday, right up there as well. Not to mention, all we did is I highlighted at the time this bearish rising wedge, which we broke down. We got a sell signal, and again, it hit the first target and it bounced. There was on the daily chart, 65.51 was my first target, and we bounced, and we've been back testing. So this is just like the S&P 500, and that's why I said they go hand in hand. And the only thing is, you'll get more bang for your buck if I'm correct on my call here. XOP, if it comes back down just to that first target again, we're going to fall from higher levels, and you have about 19%. And more, if it happens the way I think it'll happen, meaning a pretty fast unidirectional rip, drip, the inverse two-time ETF for the same sector. It tracks the same exact ETF just two times. It should do better than 20%. I'm sorry, better than 40%, because of the way the leverage works when you have these strong trends. You don't want to be in a leverage ETF during this period of time when you're chopping around. You want to be in them during these periods of time. And again, that's where, if we get a swift drop. Now on the way down, you can see we have first support here, give or take. I need to move that line up, which I did now, about 72. If that breaks, and that opens the door to 63.51, and then maybe a back test. So here's what I'm looking at. If you just want to know, okay, Randy, if I want to just tuck this away, what is a longer term swing target? If you're correct, the market starts breaking down, oil reverses, it would be potentially all the way back for a back test of this blue primary uptrend line, and or that 56.31 level. That's price support. Remember, that uptrend line is a very important trend line. It was quite bullish. We broke above it, so I need to say that. I can sit here all day long and make a bullish case here because we broke out of a primary downtrend line right there. What I'm calling for now is just a back test of that trend line. If we got a back test, that's going to be a big drop in energy prices. But let me just keep it simple, and then I'll move on to the next one. The case to short energy right here, right now, even though we're still needing some more sell signals in the market to help really increase the odds, is the same case I made back here a few weeks ago, but even better. We are at rallied into resistance while overbought with negative divergence. All I'm doing here is extending those same divergence lines we had in place the last time it was a short, and they're just bigger divergence, leads to potentially a bigger drop than we had before. Okay, so now we'll go to XOP. I'm sorry, XLE, big energy. And at the time, that was the one thing, and that's why it wasn't so, I wasn't super aggressive or I didn't have super high convictions on it, because XOP, all over the place. XLE, this is the big energy ETF. This has a very high weighting in Exxon, Mobil, Chevron, Schlumberger, all big oil companies. And so this one's probably more important than those overall, especially to the stock market. But at the time, you can see we were shy of my big. I didn't even have it at resistance. I had resistance around 47, just a hair over. We'll call that $47. It was this major reaction high here, this period of consolidation there, and I could easily see us heading up there, and I laid that out as a possible scenario, and that's what we did. So now we got that first pullback. So there's make it no mistake about it. There was a trade to be made. We pulled back. We back tested the downtrend line. We bounce, but in doing so, we've only extended the negative divergence again that was already in place then. So we're once again at resistance and overbought, which to me makes a very objective case for a short entry. I'm going to give another, upside target here. So look, either we are in some super roaring bull market that's got a lot more juice left in it before we have a decent correction, and if that's the case, then we can take out $47 with conviction. We're going to probably go up to 53.61. I don't think it's going to be the case. I think we're going to come back in for another pullback to back test the trend line again, and that about 38-ish support. And that'd be a big drop in the energy sector, and you're not going to have that without a drop in the stock market. So, like I'm either going to be right or wrong on the trade, and most likely it's going to take the S&P 500 at least a little bit of weakness, because remember, energy, it's not what it used to be. It used to be a big component of the S&P 500. It's much smaller. I have not updated this number in a while, but it's only about 3%, but it still has usually you'll see an impact. And again, lately that crude oil and the stock market have been moving most of the time in sync, again due to economic expectations. And then finally, XES, that was the other one. Those are the three big energy ETFs I follow. Look, if XES has more upside, this is the big level right here. That's comparable support back then in late 2019, early 2020, that once broken started the waterfall sell-off in this sector. That's oil and gas equipment and services. But here we are. We're right at the same level we were last time I pointed it out as an objective short, 55.44. We had the pullback. We hit my first target, 47.75, which is this reaction high right here, and these reaction highs right there, and we bounced and we're back there again. So if things happen the way I think they might, we come back in and we back test the trend line. This is another one, big primary trend line. It was taken out. So longer term, that's bullish unless this breakout fails. And I can still make the case right now, which I'll do for you, that I'm just looking for a correction at this point in time, and it could still be a longer term bullish scenario. We break out right here, back test the trend line and support, and then go on. This I'm going to put a question mark by. I'm not going to go ahead and right now and say I'm longer term bullish to energy stocks, but I can certainly see that, and I'm have to lean this way right now because that's been taken out, that trend line. So let's just say forget about 6 months, a year from now. I'm talking near term, near to intermediate term. I'm bearish on the energy stocks. And look, and the thing about it, again, it's trading 101. Do it mechanically. I take objective entries, short the energy stocks here with a stop somewhat above. If you want to give it a big stop, you can go 64.30, but that's a pretty big drawdown. Depends how much you're shooting for. That'd be about a 15%. You'd go into water by about 15-16% to get there. So I really wouldn't let it go that much. If it takes out 55.44, but it's everything I just talked about together. It's not just XES, if that's the one you're going to target. Look at XOP. Is that at or below resistance? In other words, if XES broke out above 55.44, but XLE and XOP were at resistance, and CL crude oil broke down below that 60-minute bearish wedge and was heading lower, then I would suspect that to be a false breakout. These guys, birds of a feather, tend to flock together, and that holds true with the energy stocks. They're either mostly moving up or mostly falling at the same time. Okay, so that's it. In conclusion, to wrap it up, we don't have any sell signals on the energy stocks. We don't even have a sell signal on crude. I started out with that crude CL 60-minute chart. We have potential bearish setups, but we have an objective entry, short entry on XES, XOP, or XLE and the energy stocks there, because that is a rally into resistance with divergence. So those are the two ways that I'll enter a short trade: either a rally into resistance that I expect a failure at, in other words, I don't expect the stock to go through there, or a sell signal which would come on a break of support, such as a uptrend line or a price support level or a bearish chart pattern. All right, I'm going to wrap it up here, get the video out to you guys, and of course I will follow up. I didn't do it in this video with more accurate targets. You know, I'll have to update these charts. I haven't done that in a while, so I just wanted to get the what I'm seeing out to you guys and what to watch for, especially Apple and Tesla. I'm really eager to see how those guys finish the day. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.